Hello and welcome to Moneycontrol. You have tuned into IPO Watch, and today we are going to be talking about INOX India, manufacturer of cryogenic storage tank, which is hitting the primary markets with its initial public offering to raise roughly around 1,459 crore. The company has fixed a price band in the range of 627 to 660 per share for its public issue. But let's understand more details from Siddharth Jain, who is the promoter and non-executive director of INOX India Limited. Afternoon there, gentlemen. Thank you so much for taking out the time to have this conversation with us.
It's my pleasure to be on your show. Thank you.
Let's start off with what does the company essentially do, right? The company designs, manufactures and installs cryogenic storage, and also has the first mover advantage within the space, given there is no listed comparable within the space until now. Correct me here and tell us more about your business profile and clients, to be specific.
Sure, thank you. So first one must understand what is cryogenics. Cryogenics is handling any fluid from below minus 100 degrees centigrade till about minus 270 degrees centigrade. So our equipment that we make keeps cold things cold. These are double-walled vacuum insulated tanks made out of stainless steel, with vacuum in between for the insulation. So our end markets are primarily, we are in three segments. The first is in industrial gases, second is LNG, and the third one is cryoscientific. So we specialize in customized cryogenic solutions. We deliver to almost 1,200 customers. 200 out of them are global. We export to about 60 countries. 45% of our revenue comes from export. And a lot of the end applications that we have are in the clean energy space. Primarily, our end tanks are used to store liquid hydrogen and liquefied natural gas. Liquid hydrogen, as everybody knows, hydrogen as a molecule is being seen as the final frontier in the world's transition to clean energy. And LNG is the short-term, mid-term transition fuel. It is the lowest CO2 emitting fossil fuel out there. It is being used to replace the entire diesel and LPG infrastructure in the world.
Sure. Just to understand your business, talk more about your clients, that's A. And also the company has got no listed peer, at least within India, right? There is no listed comparable that one could look at. But globally, if we're supposed to pull out some data, maybe something like an Air Liquide, Lint PLC, Chart Industries, Air Products are going to be your counterparts. How different is your business proposition or offering as compared to these companies?
So most of the names that you just mentioned are in fact our customers, not our competitors. And very rightly mentioned by you, there isn't any listed comparable in India. The only one related global comparable is what you mentioned as Chart Industries, which is based out of the US. But in India, there's nobody else doing this. We specialize in the cryogenics application. Where we stand out is we design, engineer, manufacture, and supply cryogenic solutions to the entire world. They can be any shape or form. We make equipment that is on a ship, on a rail, on the road, in static condition, some things that go on rockets. One of our biggest customers is ISRO. And when ISRO built the second launch pad in Sriharikota back in the early 2000s, we played an integral role in the construction of that entire launch pad. So in terms of our customers today, a lot of them are the Fortune 500 companies, all the world's largest industrial gas players that you mentioned earlier. They're all our customers. And we also have some of the world's leading oil and gas players as our customers in the LNG space.
Sure. Let's talk about the offering of 1,459 crore. It's a complete OFS only. There is no fresh issue involved at this point of time. A, why the OFS and why at this time? Why just OFS and why at this time?
Sure. So, we have a very healthy balance sheet. We are debt free. We have about 220 crores in cash. We've been funding all our capex internally, including our working capital requirements. The primary reason of doing this IPO and doing an OFS is the fact that we don't need any capital in the company at this point. But we do want visibility. And we since exports is a very, very core component of our strategy going forward, to being a publicly listed company certainly will help us as we try and gain market share in the global economy in cryogenics. The equipment that we make is primarily bought for capex needs, and whenever somebody wants to buy equipment for capex needs, they have to be very sure about the brand and the quality that they're buying. So this will certainly help us in doing that. We have completed 30 years. We're 30 years young. It's a kind of a coming of age for us as well. We've developed a very strong reputation. Our quality is fantastic. We have healthy margins, and we thought the time is ripe as the world transitions to clean energy, and for us to gain a larger global market share. Listing was important to gain that visibility.
Sure, I was also checking at the acquired price of the shares. And correct me here, I mean, we're looking at promoter Siddharth Jain has acquired in shares at a price of 100 rupees as of October 5th, 2021. Manju Jain has acquired in around 30 rupees, if not wrong, in March 17, 2022. What explains that lower price in 2022A? What explains the doubling of the issue price at this point of time? What has drastically changed within the company?
So I'm not sure of this data, where it's from, but having said that, it was a private company, and it has been funded by us personally from the beginning for the past 30 years. The issue price is decided by our bankers in conjunction with our board directors, and it takes into account the future potential of the company. As you know, our tagline is historically futuristic, and the products that we make, we've developed this unique reputation of being one of the world's leading supplier of cryogenic equipment. So there are tremendous barriers to entry. We've developed this skill set and IP over the past 30 years. So it's not something that's very easily replaceable.
Sure. Apart from the barrier to entry, what explains this kind of valuation multiple or the issue price that the company is demanding? Sure, one of the tailwind that is working in the favor of the company is the entry barrier and the first mover advantage. If you can dwell on that a little bit, just to explain the rationale behind this pricing mechanism.
So we last year we had an EBITDA of approximately 223 crores, and we had a profit after tax of 153 crores. In the first 6 months of this year, we've done 145 crore EBITDA and a 103 crore PAT. If you were to annualize those numbers and you were to see the valuation that has been set out by the bankers, we feel it may be a fairly priced issue.
All right. Let's also talk about your financial performance in that case. Essentially, let's talk about your total income, consolidated total income, which has increased at a CAGR of 27% from 21 to 23, from a number of 608 crore to 984 crore. What growth can be expected going forward? Are we expected to maintain that 27% revenue CAGR, or you think you'd be able to outperform?
We certainly hope to outperform. We, of course, can't make any promises, but looking at our three legs of growth and the fact that we're growing at the pace of clean energy gives me the confidence that we should be able to perform very well in the future.
Any ballpark figure that we can work in with? 30% growth is something that we can look at. You think that's a justified number?
We have our past historic performance. I certainly feel that using the past as a go-by, that's something that we endeavor to achieve going forward.
All right. Let's also talk about the settlement arrangement between Jain family. I was reading your RHP, and there were a couple of components which are working now as an arrangement and a settlement. Is that complete? Can you explain that corporate structuring bit to us in terms of settlement? And are there any more companies yet to see change in the ownership pattern due to the family settlement?
So the restructuring that we had was back more than 2 years ago in 2021. That is 100% complete. And we have three families in our group. One is INOX Air Products, the other one is INOX CVA, and the last one is PVR INOX. And there are no other changes forecast.
All right. And within the settlement, in terms of the whole group perspective, how does that work?
I'm not sure of your question. There is no other group. It's just us now. So the settlement or the reorganization within the family that happened 2 years ago, and it's already complete.
So there
and
are
there's pending.
fair. That's the limited point that I was trying to understand. If there are more companies yet to see any change in the ownership pattern due to the family settlement. And okay, let's also talk about your EBITDA margins. It stayed in the range of 24 to 25% thereabouts. What are your margin drivers going ahead? And do you expect to maintain that 24-25%, or you think you can outperform perhaps the margin profile as well?
So our EBITDA margins have been more in the 21 to 23% to 24% range. And we certainly feel that that's a healthy margin, and we hope to continue that going forward. We are one of the lowest cost producers of cryogenic tanks globally. And, we export all over the world. And after you take that into consideration, including the shipping costs, we certainly run a tight ship, and fairly confident we'll be able to maintain that going forward.
All right. So apart from that, let's also talk about your revenue drivers going forward. You said you're going to be outperforming the number of 27% that we've seen from FY21 to 23. For a number which is beyond that, what do you think would be the drivers for taking the growth forward?
So, I obviously can't comment that we will outperform. It is an endeavor to outperform. I can't confirm that. And the growth drivers, as I mentioned earlier, were three of them, and all of them connected to the clean energy space, primarily the adoption of hydrogen as the final or liquid hydrogen as the final fuel, LNG, as well as our cryoscientific applications. The fact that we excel in doing customized cryogenic solutions for the holy grail, the lowest temperature of even for liquid helium, is testament to the quality of the product that we make. And now that we've established our name in this field, we have the ability to exponentially grow on that.
All right. Let's also talk about your capacity utilization, right? It's come down from 75.9% or roughly 76% in FY21 to roughly 70% in FY23. What explains this decline that we've seen in utilization rates, and what can be expected going forward? Also, your revenue from Kalol unit has come down from 76% to 69% in FY23. What explains that as well?
So there is our average capacity utilization last year was 70%. And since we have three manufacturing plants, we keep, playing around with the load. One is an export-oriented unit, one is a domestic unit. So we keep playing around with that. But in fact, we see great potential for our product in the future. And we've just invested 80 crores in H1 this year to set up a fourth manufacturing location. And we always invest ahead of demand. So our main aim, the reason we've made this investment is because we believe in the future demand of our three product lines, our three end customers. And, we don't hesitate from doing CapEx ever. We, in fact, looking to grow that even further. What we've just invested right now, the 80 crores is phase one of our expansion. Over the next couple of years, we will be further enhancing that.
So essentially, you're saying that you perhaps saw a little less demand coming in for the products, because of which you adjusted your capacities, which led to lower utilization, if I've got that correct?
No, actually, if you see our revenue, we've been growing. So there hasn't been a reduction in demand. When you have a manufacturing facility, the capacity utilization is not calculated based on, we manufacture techs. So capacity utilization is a bit of a misnomer in that. If you look at our revenue, we have been growing, as you rightly said, 27% over the past 3 years. So and we haven't added any capex So this has been our first new capex, which will help us grow even more in the future.
All right. And what explains a little lower revenue coming in from Kalol unit? I mean, what led to the change in the adjustments as you just
So
mentioned?
the Kalol unit is focused on domestic sales, whereas our Kandla unit is focused on export. So every year we have a difference in the product mix and where it's going. And as we see exports rise, we will see more sales from the Kandla unit.
All right. So let's also talk about your order book in that case. A bit of bifurcation there, 10,366 million, if I've got that right. Within that, the split is 52% comes from industrial, 25 from LNG, and 22 from cryoscientific, if I've got that right. Do you intend to change that mix anytime soon? And how much is the contribution domestically as well as export?
The mix is from our customers. We don't decide that. We will take business from wherever it does come. And we're very happy to see this product mix changing. We believe all three of our verticals have tremendous growth potential. As you rightly said, cryoscientific is up at 22%. It has increased from last year. But for us, all three of them are equally important, and we hope all three of them grow at a very fast pace.
All right. Since the first 6 months of this financial year has completed, the reason why I asked you this is you can see probably now the projection in which the trend is shaping up from your customers, right? Do you see a change in any of that mix within your order book? And which industry technically gives more margin, is more margin accretive to your business?
So, just to understand our order book, we have two kinds of business. We have the standard tanks and the non-standard tanks. Standard tanks are usually delivered between 4 to 5 months, whereas our non-standard tanks are delivered between 7 to 12 months. So when you see, as you saw, cryoscientific increase, that's because these are all long gestation products. Some of them take as long as 12 months, so those will be disproportionately high in our order book. In terms of margin, they're fairly close to each other. Certainly the margin in LNG and cryoscientific is slightly higher, but not too much higher.
All right. In that case, I'd also want to ask, let's also give more understanding towards the financials of the company. Clearly, it's been a good run when you talk about the top line performance of the company. But in the first 6 months, how have the trend shaped up? Are we seeing anything which is exceptional and which is not perhaps been spotted in the RHP, something which seems like a shift in your outlook when it comes to the financials, both in terms of your top line as well as bottom line growth?
Well, these are all directional. What you see in our RHP, what we've declared for the first 6 months of the year, our top line is about 580 crores, which has grown at approximately 17% year on year. Our EBITDA has been about 145 crores for H1 this year, which is a growth of about 20+%. And our PAT has grown at about 23% at 103 crores for H1 of this year. So certainly, this is directional because we don't have seasonality in our business.
All right, Mr. Jain, we're just going to leave it at that. And thank you so much for taking out the time and having this conversation with us. All right, with this, it's a wrap and goodbye from the entire team. It's INOX India, which is coming up with an IPO December 14 price band in the range of 627 to 660 per share. It's a complete OFS only issue, and the promoters seem to have made a good return on their investments, at least the selling promoters. But with this, it's a wrap.